And good morning and welcome. We are broadcasting live officially only on onedealaway.com. This is Money Matters. My name is Nav, and today we're going to be continuing a little bit of a conversation about business and real estate and the business of real estate. Just because it is really, really important, and there's many things that are happening out there that I think it's important for us to talk about. One of those things that we're going to be discussing is about refinancing and what's happening in that sector of the world. Because many people are still in the need to refinance component, and so we need to talk about what's going on. We're going to be having a further discussion about the iBuying program, because for many of us this is a brand new thing, and so I want to make sure that we are discussing what we need to discuss when it comes to this particular section of the market. We're going to be taking a look at the banks and the banking industry and what's going on there, because without banks, all of us kind of go down, because we need them to be able to finance us and to provide liquidity for us. And so there's a lot of things that are connected. And so the reason that I wanted to really focus this week predominantly on real estate, on banking, and that kind of industry right there, a lot of it has to do with us preparing for what is to come, right? And what is to come? Well, we don't know. Nobody knows. Everybody's crystal ball, I would say, is broken. We can try to guess and assume what's going on, but none of us know exactly how things are going to turn out. So, with that in mind, I wanted to make sure that we take a look at what's happening and what are the banks doing, what we should be doing, and let's just really talk about the two largest sectors, banking and real estate, because market can crash and the rest of us will be just fine. DeFi can be shut down and most of us will be just fine, right? A lot of things could really disappear with, for example, we talked about H&M closing stores, for example, right? Or a restaurant going out of business. And while it's sad and affects quite a few people, especially the patrons and the employees and the owners, the vast majority of individuals have basically no positive or negative impact from it. But if a housing market was to completely collapse or the banking industry was to completely go away, everybody would feel it. And that is the reason why I feel it's incredibly important that we talk about it today. Let's. All right, and good morning. Happy Saturday to you. I do want to welcome everybody who's watching this live on onedealaway.com. Make sure you sign in. Make sure you say hello, and we're gonna do Q&A at the end of the show as always. If you're watching this elsewhere, do me a huge favor: smash the like button, subscribe, hit the bell button, get notified, forward it to friends, so that way we can hang out and you can continue to receive these things. But only if you're enjoying learning about things like money and business and news when it comes to all of that stuff and some strategies. And when we talk about money, we focus predominantly on real estate and crypto. But of course, we look at the bigger picture, because looking at the larger picture is what makes sense, in my humble opinion. So let's do this. Let's talk about it. So here we go. Here we have first a bit of news of talking about really refinancing the mortgage. And if you have not refinanced quite yet, but are still thinking about it, and you have heard about this potential additional expense slash cost to us all, and you're wondering, whether you should or should not, here is a bit of news to kind of give you an information whether it makes sense for you to refinance or not. So it's about to get much more expensive, right? Not like, tens of thousands of dollars, although it could, but it's going to get a bit more expensive and you need to be aware of it. So, as you know, it has been refinancing has been incredibly hot. It's been happening for a very long time. Then we received this news in August that the Fannie Mae and Freddie Mac refinancing, which is vast majority of refinancing, is going to basically be hit by the Federal Housing Finance Agency with this additional sort of cost, and it's basically like, oh, this is supposed to help us recover. What? No, no, it's just government is just looking for excuses to make more money. That's it, and to tax us all and to fee us all to death. So that's basically what it is. But anyways, they announced and saying September 1, and everybody was like, whoa, 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 you can't do this. So finally, 2 weeks later, they said, okay, fine. I guess it will be December 1. So December 1 is coming, whether we want to admit it or not. And so basically, what is going to happen is that if you're able to close prior to December 1, you save yourself 0.5% on the cost of the loan, on the loan completely, right? Now, this particular fee of 0.5% doesn't necessarily the Federal Housing Agency say, well, this is not for the consumers, this is going for the mortgage lenders. Well, guess what? They pass on the costs. Most people don't understand. I don't know how people cannot grasp the concept that when you increase expense for a business, the business, in order to stay profitable, has to pass it on to the consumer. At the end of the day, the consumer pays for it all. So when the minimum wage goes up, the cost of everything goes up. When the taxes go up, the cost of everything goes up. When things, right, like new regulations, rulings, all of that stuff, all of that is passed on in a form of higher price to the consumer. At the end of the day, we all pay for it. I don't understand why people cannot do the simple logical math, but it is true. And even the quote unquote smart people in these agencies are just not making the connections. But, anyways, it's not like a huge sum of money, but it is a part of money that is going in. And instead of this kind of coming in on the top of your loan, what the mortgagers are basically going to do is they are going to tackle this onto the rate that you are going to be quoted. So the way that the fee will affect refinances is quite different from how even a savvy borrower might expect. This fee is not going to show up on the loan docs. Instead, Fannie and Freddie charge lenders the fee when they purchase the loans, and then lenders have the choice of whether to pass on the cost to consumer or not. Most will likely pass it on in form of higher mortgage rates, roughly about an eighth of a mortgage point rate increase on 30-year fixed, plus or minus. Now, they still want to keep it competitive, right? Because if I offer, a 3.5% loan, right, but somebody, my competitor offers it at 3.3, obviously you're going to go with them. So I'm going to lose on the customers. So, you always have to play this game of like, you want to charge just enough, but not too much, right? So here is kind of what that would basically end up happening is that they would because Fannie and Freddie only back up conforming loans. So jumbo loans are not part of this piece, and the other piece that is also exempt from this extra fee are the refinances of $125,000 or less. Now, with the average home price in United States being about $350,000 these days, most people will fall into it. Jumbo loans are not going to be part of that conversation, and jumbo loans are anything above $510,400 in a regular market or $765,600 in more expensive markets, things like New York City, for example. Right? So that's where the high cost areas are. Now, what basically they're saying is that, because it takes a little while longer to sell, and the closing part of the process is not just about you getting qualified, but also that lender being able to sell that mortgage and be able to make money. And so all these different components of the business, it can take on a short end of the stick, so to speak, about 15 days, and it can go to 90 days or above. The average right now to refinance is about 51 days in the industry. So that would basically make it so that if you're looking to refinance and you want to kind of get out of the stuff, you basically have next week. That's it. You want to do it next week and move as fast as you humanly possibly can. So that's one of the things that you want to pay attention. The other piece that you also want to pay attention to is that you want to shop around. Some of the loan mortgagers have already preemptively pricing their loans to cover this additional fee, the cost of doing business, as they call it. So you want to make sure that you look around and find the best possible thing that you can find, right? So what you can do is that if as long as you can kind of get in and close stuff prior to October 15th, you should be able to avoid the December 1 extra, and be able to close prior to December 1, fingers crossed. And, avoid this extra fee, but you also want to be able to, you want to shop around for rates, right? Number one. Number two is if you're looking for a shorter period of time to close, you can look for that sort of, I want to lock in for about 15 days. And here is the part that they're talking about here. The shorter lock period, the better deal you get. Short rate lock periods require fast work on the part of the borrower. Upload pay stubs, tax returns, and everything else the loan officer wants the minute the rate locks, and respond quickly to more requests. So you basically are going to have everything ready to go. The moment they let you in, you upload everything you possibly can, and pay attention to that, email, phone call, text, however it is that you decide to communicate with them. And then as they ask for something, boom, you get it, boom, you get it, boom, you get it. Because what you want to do is you want to be able to move super, super fast in order to try to close within that like 15 to 30-day closing period of time. And, you also want to try to do a rate lock right now. The reason for that is, and again, you don't have to, this is not a financial advice. Just a recommendation for many in the business is that you want to do the rate lock, even though the rate might drop a little bit if they end up tackling on that extra piece. So if the rate drops, say 0.02%, but they add on the 0.5% on the whole thing, well, you're actually in the negative, or you're getting a little bit worse rate. So if you get a rate and you really, really like the rate, just lock it up. Once you lock that rate, you can move in super fast, and you know exactly what you're going to be dealing with. There's not going to be any surprises on the closing day when you're signing the documents and looking them over. It should all make sense. You've already seen it 7 different times, and you're able just to sign, although it takes a while to sign, but you can just sign your way through and close it and make it official. So you want to, there's a couple of other things that they're basically talking about, and potentially pursuing an appraisal waiver. So it's taking longer to get appraisals these days, and sometimes it can take 3 to 4 weeks to do that. And if you're purchasing stuff, I definitely say get an appraisal. If you believe that what they quoted you, that they can get to you from the market value and stuff, and you believe that they are grossly wrong, and you're willing, and it's going to, what you're going to be able to save or preserve is going to cover the additional cost of the appraisals and inspections and all of the other stuff. Then you can go out there and just say forget the appraisal, especially if you have done it recently and you're savvy about the market, you kind of understand where you probably are anyways. You can then basically say just waive the appraisal and let's just go with what we got. Especially if you're going with the same company, you can try that as well. Typically the same company, if you like them, as much as one could like the company that they owe money to and have to pay. But there are companies that are easier and worse to do business with. So if you find that your company is particularly easy to work with, relatively easy to deal with, and you're like, I don't have any complaints about them, then you can try to go with them, and typically you will get better deal than trying to go with somebody else, if you're dealing with a smart company. If you're not, then go ahead and shop around and see what you can find. So this is one of those things that I thought was really interesting for us to take a look into and understand of what is coming and how does that impact us, because I know that many of you that are watching this show are interested in real estate as an investor, as a homeowner, as a potential homeowner, potential investor. And so I think it's important that we kind of talk about some of these components and metrics. Now, if you miss the deadline, you miss the deadline. It's not the end of the day, right? It's not like a huge amount. It's not like we're going to go from an average of 2 point something rate, to, depends who you ask. It's like 2.9 to 3.01. So let's say 3%. Let's make it simple. But it's not gonna make a big of a difference. Not like we're going from 3% to 13%, and it's like whoa. it's not going to be that giant of a drop. And I think that with so many people who have already refinanced, as I have said, I think that the rates are going to have to drop even further if they're wanting this whole business of refinancing and stuff. So I could be completely wrong. We'll see. This is very much connected to the bonds as well. But I don't see us getting out of this hot mess anytime soon. And some of the other news that we're going to be talking about in a few moments during today's episode has to do with the banking and the Fed and what they're doing. And this is what's driving my thinking that we're going to see even more um, affordable loans, better loans and stuff. So even if you have to pay this extra 0.5% on the size of the loan, there could be other components that could help. And so at the end of the day, for us, relatively speaking, it's going to be a wash, right? So one of the other pieces that we talked about recently, and switching the topics just slightly, has to do with the iBuying program. We talked about Zillow, how Zillow is getting into the iBuying, aka flipping houses and stuff. And I do remember I still owe my students a lesson about that, so I promise we're going to schedule this or shortly, and you're going to be invited to the live training. So don't fret. I will make sure that I announce and send the emails out and all of that stuff so we can do it together. But what I think it's important that we do discuss right now is another company that is part of the iBuying program, because they are going to be listed publicly or have already listed publicly. I don't exactly know, but it's called Open Door. So let's learn about Open Door. So here we go. Open Door is a technology startup that lets customers rapidly sell their homes. iBuying will go public through a merger with the blank check company. That's the SPAC, right? We talked about how SPACs are the thing that is happening right now. So SPACs are like the hottest thing right now. Forget the IPO. SPAC is the way to go. It's SPAC. You can watch the videos. We've done plenty of that, or you can do your own online research. Shares of its soon to be acquired soared 35% during normal trading hours before falling 7% early on Wednesday. It gave a value of $4.8 billion dollars and is breakthrough for the industry. Open Door dominates the rapid home selling markets. It's also known as iBuying, right? But last year it lost $339 million dollars on revenue of $4.7 billion dollars. However, they insist that they are simply burning money in the short term while pursuing growth, and they are burning a lot of money. Open Door sold 18,000 homes last year, making over 3 times bigger than its next larger competitor, Zillow. Other competitors like Redfin and OfferPad trail far behind the top two. 5 years ago, Open Door was in 2 or 3 markets. Today, they're in 21 markets. In March, the company paused acquisition as it tried to gauge the coming economic damage. In April, Open Door laid off 35% of its staff. And then the company spent the following months fully digitalizing home selling process from inspection to notarization, some of which has been conducted in person before, and I think more and more of that will be coming. Open Door also launched a new feature called Home Reserve, in which it will buy a new house for customers in cash while attempting to sell their existing home, and then once initial house sells, customers get the deed on the new property. So to explain what the process would look like is that, say you want to list your home with them, right? You list with them and you're waiting for the sale, but you're like, oh my gosh, that yellow house right over there, this is what I want. They take a look at, see if you can afford it, and then they'll end up basically buying and getting off the market for you, waiting for this. And this really simplifies a lot of the business, which I think there's a lot of benefits to this stuff. But again, do expect that you're going to get less money and so on and so on. We talked about this when we talked about Zillow, so do plan for that stuff to be happening. Um, Offers on homes for resale in June rose 153% as compared to the prior years. So they're talking about like, hey, this is really good, this is happening, but you also need to remember that homes offers on home for sale, the entire like buying and selling stuff rose in June, July, August, everywhere except for maybe New York and San Francisco and that kind of stuff. But it's been a boom nonetheless. So that's one of the pieces that you also need to understand. Now they started in 2014. They raised basically $10 million in Series A and launched in Phoenix, and then they have been kind of growing from there. And they're basically they're not profitable. They believe they're going to be profitable maybe in 2023, but their revenues are down 47% or so, and projections, everything is down. So they are losing money like crazy. Nonetheless, they have an insane valuation. So while I do like the business model of what they're kind of doing, because I think it does have value long term, right now would I buy the stock into it? I know I have hard time investing in a company that's been operating for 6 years and is still burning a ton of money. And I know that that's the new business model these days, but I struggle with that business model. That's like you bankrolling me, but I am spending way more than I'm earning consistently, and you consistently are basically, just burning money on me. And I can't see myself doing that stuff. So, not a financial advice whatsoever. I do wish them all the luck. I do think it's a really cool idea, but I just struggle personally to do that stuff. You do what makes sense for you, and do not listen to my crazy thoughts and ideas, and do what I do. Okay? Make your own decisions. Speaking of San Francisco, well, we do know that the rents are plunging yet again. And of course, the wildfires are not helping. So, what happened is that while the rent prices are continuing to plunge throughout the U.S., which I would disagree, they're not plunging throughout the U.S. They might be plunging in quite a few areas. There are many areas that the rental prices are actually holding. Some of them are actually going up. But there is decline, and there's decline in some key markets. San Francisco, New York being one of those key markets, and we've been talking about it on this particular show. So if you're interested, you want to definitely take a look at this stuff. Now, the San Francisco did actually decline quite a bit, and the median rent for one bedroom apartment in San Francisco dropped more than 20% from a year ago to $2,830, which is still way more than you can get anywhere else. And I think it's going to continue to drop. And, before it starts making sense. But by that point, I think the prices are going to have to completely reshuffle in San Francisco. And at that point, it might make sense to buy in San Francisco. Just my personal 2 cents. Again, don't listen to me. Month to month, the price of medium one bedroom, the city dropped nearly 7%. And they're basically saying that the houses in the city are still selling, although it takes longer period of time, and not receiving as many bids, and reached the highest number of homes listed for sale in August at 1,483 homes, and the price cuts have become more common. So, like I said, they're going to have to cut the prices in order to have people to entice to buy, because who's going to start buying at some point? Homeowners are not going to want to do it, so it's going to be on investors hopefully are smart enough to actually do the math, and we invest with pen and paper, right, and thinking critically and logically through it, as opposed to a heart of like, oh, it's cute, look how pretty. And you can still go and say, oh, it's cute, look how pretty. However, you look at the math, and if the math makes sense, then you go for it. Right now, the math doesn't make sense unless you operate the way that Open Door operates, with you being willing to burn money over the unprecedented future. I keep saying you want to be profitable from day one. You don't want to buy something that you're hoping and praying it goes up in the value, because you might find yourself hoping and praying for a very, very long time, and that day may never come. So, prices in the cyclical markets especially, you want to be very, very smart. You want to buy at the bottom, not at the top, right? And when you buy, you want to make sure that the math makes sense, especially if you're doing it long term. If you're doing a flip, same thing. You want to be equally as smart of what is the price now. Are the prices going up, or are they going down? If they're going down, flipping might not make sense unless you find something that is ridiculously below market. Say for example, market right now would price the house at 400,000. The market's prices are tumbling kind of down, so you're thinking by the time I'm done I could sell it for 350. But when I finish, with the purchase, with the renovation, with everything else, and holding it for extra time, because it's going to take extra time to close now, in those areas, I can still get about, I don't know, I can still finish the whole thing at 250 to 300. It might make sense, but then you want to make sure you take into account the cost of servicing, the labor, the taxation, the whole 9 yards before you make a decision. All right, fair, cool. That's a freebie one right there for you. Now, final piece that I promised to talk about as a big, large topic that we need to discuss has to do with banks. So let's take a look. What's going on with the banks? Well, the Fed is clearly seeing something that we all should be keenly aware of. What are they seeing? Well, let's find out. The Federal Reserve announced that in the light of economic uncertainty and to provide a cushion against loan losses and to support lending, it would extend for another quarter, so through December 31, the blanket prohibition on share buybacks by large banks, and it would also cap dividend payments. In June, all large banks were sufficiently capitalized to deal with the fallout. However, Fed now thinks the banks need to be even more sufficiently capitalized. Many banks had voluntarily halted share buybacks in March, and as far as Fed is concerned, the crisis is not a blink, and banks need to be prepared for what's coming at them. And what is coming at them? Well, let's find out, because if they need to understand what's coming, we need to understand what's coming. So, what is actually coming down the pipeline? Well, down the pipeline are things that we have sort of put in a freezer, but not in a deep freezer, or as they say, on a thin ice. Credit card loans, auto loans, mortgage loans, commercial real estate loans, can we say student loans, and other loans have been moved into deferral or forbearance programs. Residential backed securities, residential mortgage backed securities have been placed into the government's lap, so those are not for banks to worry about, right? And so those are the things that we don't need to worry about with the banks. Many people are worried about that component because of the recent burn, 2007, 8, 9, 10, right? Um, but that's not what they're saying. No, 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 no. You got the whole thing wrong. This is one we should not be worried about, not residential backed mortgages, but everything else. There has been spectacular number of bankruptcies among brick and mortar retailers and the oil and gas sector. And a lot of these things are basically on the books of the banks. Overall, consumer and business bankruptcies have not spiked as they would have given the magnitude because of the enormous amount of stimulus, whether it was unemployment checks, whether it was direct payments to all of us, for those that got it, right? Whether it was the business support in the form of the PPP loans or EDDL loans, the large business support programs such as giving money to like airlines and Fed kind of going in and direct purchasing and direct lending programs and all of that stuff that was kind of happening, right? But what's happened since then? Well, a lot of those programs are dead. They're gone. They expired. They had an expiration date and they expired. Some have been extended, but they're not like forever. They're just slightly extended. Some stuff they're talking about wanting to push it, but that hasn't happened quite yet. So a lot of these things are going away, and that is highly problematic. So the Fed only dabbled into the corporate bond market, about $12 billion in bonds and bond ETFs, but then stopped buying bond ETFs in July and bought almost no bonds in August and likely wound shutting the program entirely down in September. We don't know that quite yet, but we'll know it over the coming few weeks, right? The Fed is telling banks, get ready, you're going to have to face the loans. Stocks of U.S. banks have already been getting battered, and with the bank index down 36% year to date. And here are the big four banks and kind of what's going on. Now, he basically is saying that, hey, I have this big four bank index based on market capitalization closed at 685 billion, which is 60 billion less than Facebook market cap. So imagine Facebook actually has a larger market cap than all of the four big banks, and the four big banks are JP Morgan Chase. Sorry about the noise, y'all. Fire truck. I can't help it. JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup. So they are actually smaller by market cap than just Facebook. So that should also give you how ginormous Facebook is and why the Congress is wanting to bring them in and say, hey, is there any antitrust laws here happening or violations of them, right? So we'll see how that rolls out, but that's an interesting piece to understand. Now, they are down 46% from its peak, and the index is now back where it has first been on December 28, 2004, nearly 16 years ago. Look at this, y'all. Look at this. So this is where we kind of hit. Remember the 2007, 2008, and then it was like a bank meltdown, and we kind of like came back up out of it, and then sort of came on up, and then we hit the high in 2018, and since then we have been on the slide again with the big old drop here, kind of trying to do some stuff, and I think there's going to be a second leg. I just don't see. I have a hard time seeing how we would not have a second leg given everything that I am seeing. However, does it mean that the stock market is going to crash? I don't know, y'all. I can see both parts of the thing happening. One of the parts is, with all of these companies being way overvalued, I mean, the stock market is way overvalued. I could see, the people kind of waking up and saying, whoa, 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 whoa. All of these businesses are shutting down, losing money and stuff. I want out. And once it starts going, it's going to go fairly down, and it's going to go from overvalued to undervalued, and then back on up, right? On the other hand, we've created a ton of money, which has to go somewhere. Now, we didn't get it. Most of us didn't get it, but it's been put into the economy. That has to go somewhere, so those companies will have to put it somewhere. Where exactly they're going to put it? Well, typically it's going to go into the assets. So as long as the banks don't completely collapse and something crazy doesn't happen, I could see all of this money entering maybe stock market, potentially real estate, right? And potentially the cryptos. So that's kind of where I see it. And of course, you could go into some of the businesses and that kind of stuff. But we'll see. We'll see how it all plays out. I do want to finish one bit of things because I think it's beautiful and kind of cool. And so, for all of you lovers of beautiful real estate, beautiful homes, architecture, design, that kind of stuff, and cool things, here is a house that is for sale. No, it's not mine. No, I'm not selling it. No, I'm not buying it. I just thought it was really beautiful. Take a look at this. Does it look like anything? It looks like boat, Nev. That's because it is. Check it out, y'all. So this is a boat turn house outside of Seattle. And it's located on Seattle's Lake Washington, Mercer Island, circa 1906 steamship Manzanita. And the boat turn house with 3 bedrooms and spanning about 1,400 square feet on roughly quarter of an acre is being put on the market. Asking price is just shy of $2 million, 1.995 million. And look how beautiful this is. So I just wanted to show you some of the photos here so that you can feast your eyes, because I think it's absolutely just gorgeous in here. So here's where it's located. So that's where Manzanita is located. Here's where Seattle is. So a little bit of a drive away, but not too bad if you are interested, of course. And I just think it's beautiful. So for me, there it is, the owners turned sellers. But I just wanted to take a look at this. Look how beautiful this is. I really like it a lot. Oh, it looks like we could potentially, I don't know. There we go. Can are you gonna play along? Hold on, let me see. No, why is there an advertisement? All right, there we go. This is what it looked like, I guess, way back when. Uh, it's kind of on the slow end. ¿Qué pasa, man? It's not working, y'all. Anyways, my apologies for that. I just thought it was beautiful. And is this where you can go and get more? It says one of nine, but you can't get the rest of them. So I guess it's just one. So there you go. There you go. There you go. Hopefully you have enjoyed this. Hopefully you have learned something. Make sure you tune in tomorrow. I promise we're going to go crypto. I didn't forget it. There was just a lot of things that I wanted to talk about these particular big industries because they have been around for forever, and without them, really the market as we know it is going to completely just go kaboom. And so we need to prepare and think about that kind of stuff. So make sure you do subscribe. Make sure you smash that like button. Make sure you tell folks, and I will see you tomorrow. Until then, stay forever money blessed, and do remember, you are only one deal away.